Hi and welcome to Leavitt Brothers tutorial on head and shoulder bottoms. Head and shoulder bottoms are powerful reversal patterns that appear as large basing periods after a substantial downtrend, and their completion may signal a trend reversal. 3 successive troughs characterize the pattern, with the middle one being the deepest and the 2 outside ones being shallower and approximately equal. The chart here illustrates a completed pattern. Let's go through the sequence of events that unfold as the pattern develops. The left shoulder and first half of the head are formed as a bounce within a downtrend, followed by continued selling pressure. This action is no different than what is expected from a stock in a typical downtrend, and at this point in time there is no way for a trader to know that a head and shoulder bottom is forming. The stock then begins its usual bounce within a downtrend, but not only does the stock get above the left shoulder, it rallies to or close to the same level as the previous bounce. The head has now been formed. This is the first sign the selling pressure may be waning and the stock seems to be gaining strength. A trend line called the neckline can be drawn between the 2 peaks. The stock then falls again, but the imbalance of supply and demand is such that the stock does not make a lower low. This is the second sign the downtrend may be nearing an end. A rally from the shallower dip, the right shoulder, through the neckline with a volume surge would mark a successful reversal of the downtrend. Like other upside breaks, a surge in volume must accompany the breakout. Failure to accomplish this doesn't necessarily mean the pattern will be a complete failure, but a yellow flag is raised. The stock may have broken out prematurely due to the overall market strength, and it may just need to pull back a little more to do more work. Perhaps form a second right shoulder before the real breakout occurs. Remember, a head and shoulder bottom occurs after a weak stock has been in a long downtrend. There really needs to be a massive amount of buying pressure to reverse the trend. The character and extent of the expected price movement after the breakout depends on several factors. Typically, it is equal to the distance from the neckline to the extreme point of the head, but this is just a guideline. Head and shoulder bottoms are reversal patterns, so there must be a significant move to reverse. The duration of the entire pattern, or how long the stock trades below the neckline, also plays a role. The longer the stock trades down there, the greater the chance that most of the disgruntled stockholders will have sold when the breakout happens. This means there won't be many investors who are looking to get out even because they've already gotten out, so the stock will have greater rallying potential. Whether the stock pulls back to the neckline after breaking out often depends on the overall market. If the entire market is strong, there probably won't be a pullback. If, on the other hand, the market is weak at the same time a stock completes its pattern, then a pullback is likely. As a side note, head and shoulder bottom patterns rarely play out as just described. Most often, the left and right shoulders will be similar but not exactly the same, and the head will not be proportional to the shoulders. Let's check out a couple of examples. Here's ALVR. A downtrend led to a 3.5-month head and shoulder bottom pattern. The shoulders pulled back to about the same level, which is nice to see from a symmetry standpoint, and volume spiked on the breakout. After pulling back to the test of the neckline, the stock continued up and hit its target projected by the depth of the head. Here's Flammel Technologies. Proportionally, the head is much bigger than the shoulders, but that's okay. The shoulders came down to the same level, so there is some symmetry. Volume surged on the breakout, and after testing the neckline, it was onward and upward. Ultimately, the stock came up a little short of its target, established from the depth of the head, but it got pretty close. Here's Lamb Research. Steady downtrend resulted in a head and shoulder bottom that saw a nice spike in volume. When the neckline was taken out, the stock pulled back to test the neckline on declining volume and then continued up. If you have good eyes, you can even see a larger pattern formed. Let's quickly go through a few more. We find it helpful to look at successful pattern formations to train our eyes. Here's Apple. The shoulders weren't well established, but the pattern was still valid. Cyber. Average volume wasn't very high, so the pattern wasn't smooth, yet it broke out on great volume and rallied very nicely. ANAD. Kind of a messy pattern, but the neckline was easy to identify. 2 left shoulders formed, and that sometimes happens, and it doesn't invalidate the pattern. Volume was solid on the break, and then it was time to contend with resistance from the left side of the chart. That wraps up this tutorial. Again, head and shoulder bottom patterns are reversal patterns that need a good deal of volume and a clean move through the neckline to confirm the reversal. The odds of success are much higher if the overall market is trending up than if it were trending down.